Joining us now to talk a little bit more about the state of the U.S. labor market off this JOLTS report and ahead of Friday's December jobs report. Stephen Ricchiuto, Mizuho Securities USA Chief Economist, joins us now. Steve, thanks so much for hopping on. I want to talk a little bit about kind of how you see the labor market right now. We just got these JOLTS numbers, but obviously, a much bigger picture out there in terms of what we've seen in job gains. They continue, and how you are evaluating the state of play heading into 2024.
Well, I think that's a great question. I think the answer to that really revolves around what we're seeing in terms of the initial unemployment claims and the continuing claims data, which feed more directly into the payroll employment report than do the JOLTS numbers. And those two indicators are very, very important historically, and they are showing us that the labor market remains very, very tight. People that have gotten fired have gotten jobs very, very quickly to replace the ones they lost, and other people are coming in off the sidelines and getting new jobs as well, which is why the participation rate is going up. So I think the combination of those two events tell you this labor market is still hot, as the high level of openings, even though it is lower than expected, as the continued high level of job openings suggest.
And, Steve, ahead of the jobs report we're going to get on Friday, we'll get another round of claims data tomorrow morning. And we just had claims up on the screen. We've seen that number remain fairly stable, I think, to the surprise of some. How have you thought about those real-time indicators of the labor market? And perhaps, coming to your view, I think you had in your note to us that people remain just much too bearish on the outlook right now. What do you think some people are, I don't know, either they're getting wrong or they want to see in the data that's just not showing up?
People really, really want the Fed to cut interest rates. And the Federal Reserve, to some extent, has been leading the bandwagon on this, which is why you've had to see, since Jerome Powell's latest press conference, a number of Fed members come out and try to step back from this idea of March rate cuts. Because, the Fed really, really would love to reverse some of the policy tightenings, take out some insurance rate cuts. The problem is the economy isn't giving them that information, and that becomes the end result driving force in here, is whether or not the Fed will have that opportunity. So people have wanted to look into the data to find things that are constructive, rather than looking at the data from a broad-based perspective and saying, hey, we had an economy that grew at 5% in the third quarter of last year. Okay, it grew 2% in the fourth quarter. You average that's 3.5% per quarter. That's a very healthy economy compared to an economy that has a trend rate of growth, according to the Congressional Budget Office, of 1.75%. It's almost twice the trend rate of growth. That's a healthy economy, and people want to ignore that, and they want to focus in on the 1.5 to 2% type growth areas, and the belief that that's going to lead the Federal Reserve to cut rates.
So, Steve, then what do you think, I guess, is a more realistic timeline for the Fed then to cut rates? And in order for them to do so, what do you think they need to see that's going to make them feel comfortable cutting rates?
Well, they're going to need to see inflation a heck of a lot closer to 2%. In addition to that, they're going to need an unemployment rate that is a lot closer to the natural rate of unemployment, which is 4.5%. And, we're well below that at this particular juncture. We're at the 3.7, 3.8 level. So the reality is there's a big, big gap between how tight this current labor market is and what a normal labor market should look like. And I think we're seeing that the labor market has not really freed up as the Fed would hope, as job openings have come down. There is some little downward dampening pressure on wage gains, but let's be honest, we're now at the point of 4% wage gains, which is, again, well above the level of wage gains you would expect if you were going to have a sustained 2% inflation rate.
And Steve, I know we're a couple weeks out from the data, but inflation has really kind of taken center stage away from the labor market to some extent in terms of the driver for the Fed. I'm curious, one, what you made of, that PCE data, 6-month, and average annualized core PCE under 2%. Everyone very excited about that. How you're thinking about the inflation picture as we head into next year, and is perhaps this an area where people think there's, too much momentum to the downside, where maybe things are going to be stickier?
Well, you have to understand, all of the decline in the inflation has been concentrated in the goods component. And the goods component is heavily correlated to the exchange value of the dollar. And the dollar has been in a very, very expensive position in the last 2 years as the Fed was in the position of raising interest rates. We peaked out in the 113 area. We then dropped to the 107 area on DXY, which is an average index for the dollar. And now we're broaching the 102 area, and we've tested the 101 area. You get back to 100 on these dollar-weighted averages, and you begin to see that the currency is no longer going to be able to provide the downward bias to goods inflation that we've been having. And considering where service inflation is, it tells you it's going to be harder to get back to that 2% type inflation rate. And to some extent, I think the Fed is willing to accept a higher inflation rate in the longer term because they'd like to not have to flirt with the zero interest rate barrier again. But by the same token, the market hasn't taken that on board, and the long end of the curve is expensive relative to a 2% inflation target, let alone an inflation rate target above 2%.
Yeah, so Steve, so what do you think that rate could potentially look like that you think the Fed is willing then to accept maybe in the longer term?
Well, I think there's enough rhetoric from the Fed to suggest that they wouldn't mind seeing inflation closer to 3% than 2%. I don't think they have a specific target in mind. They're going to be reviewing policy in the next year and deciding what they're going to do with it. But they did move away from an inflation target to an average inflation target, where they're willing to live with upside deviation in inflation from 2%, as long as the market believes they will get back to 2%. But they really are not willing to tolerate any downward deviations in employment. But when they're dealing with such a tight labor market, they have to look for the labor market to come back to more realistic levels if they're going to be able to have a 2% sustained inflation rate. So I think the answer is eventually they will settle on something closer to 3% than 2%. They haven't done it yet, but I think in their minds, they're all thinking that way.
All right, Steve Ricchiuto, always great to get your insight. Thanks so much for joining us here this morning. Mizuho Securities Chief Economist. Thanks.